Hello and welcome to Earnings Echo. We put together the most important information about Alphabet. We're doing a deep dive into their Q1 2026 earnings today, so let's get right to the hard facts. Revenue hit $109.9 billion, which is a 22% increase, and EPS skyrocketed to $5.11. Did this completely crush consensus expectations, and how did the stock react after hours?
Well, yeah, it was a massive beat on the top line at EPS. The stock initially spiked hard right after the release, but you really have to strip out the noise here because that 82% EPS explosion actually includes a one-time $36.9 billion unrealized gain on equity investments.
Right, so it's essentially like finding a winning lottery ticket in your coat pocket and telling everyone your regular salary just doubled. So if we take out that windfall, what is the actual normalized net income growth?
It's actually only 4% year over year.
Yep.
So the after-hours sentiment cooled down pretty rapidly once the market digested that the baseline business is, really just creeping up on the bottom line.
Which means we need to look at the operational drivers. If baseline profit is only up 4%, where's the actual momentum? Because Google Cloud hit $20 billion in revenue, right?
Exactly. That's up 63% year over year, and operating margins jumped to 32.9%. The core driver here is AI integration. Their Gemini models are processing over 16 billion tokens per minute now.
Wait, 16 billion tokens a minute?
Yeah, to put that in perspective, a token is basically a piece of a word.
Okay.
So processing that many is like the system reading and generating millions of full-length books every 60 seconds. Enterprise customers are heavily buying into this, driving a massive $460 billion backlog because they just can't afford to build their own AI data centers.
Sure, but billing out that capability isn't cheap for Alphabet either. All that processing power leads us to the staggering CapEx guidance they just dropped. They raised 2026 capital expenditures to, $180 to $190 billion.
Yes, and in Q1 alone, they burned through $35.7 billion, mostly on servers and data centers.
But doesn't buying a mountain of expensive servers today just mean a mountain of depreciation costs hitting the balance sheet tomorrow? I mean, AI servers aren't real estate. They depreciate incredibly fast.
Precisely. And the tone on the earnings call definitely reflected that reality. Management explicitly warned that higher depreciation and immense energy costs are going to put serious pressure on the P&L going forward.
Which brings us to the valuation reality check. They're sitting at a $4.5 trillion market cap. How does this massive spending align with that price tag?
To figure that out, we look at a reverse DCF, or a reverse discounted cash flow model. It's not an exact science, but it gives you an indication of what growth the market is pricing into the current stock price.
Right, so to justify $4.5 trillion, what exactly is the market expecting them to achieve?
The market expects Alphabet to grow its normalized net income from $135.5 billion today to roughly $453 billion over the next 10 years, which implies a 12.8% compound annual growth rate.
But historically, they boosted margins through layoffs and efficiency gains, and those cost-cutting levers are largely tapped out.
Exactly. Because recent margin expansions are maxed out, and you have that massive $180 billion CapEx dragging on depreciation. Hitting that $453 billion target relies almost entirely on pure revenue growth from AI.
So the biggest echo you need to take away today is that while Alphabet is undeniably dominating the AI transition, the structural costs are fundamentally changing their financial dynamics.
Right. The real question is whether AI revenue can grow fast enough to cover the staggering bill, or if we're entering an era where big tech profit margins permanently shrink to fund the AI revolution.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.